Good evening, dear students. So, topic what we are going to see the calculation of payback period. So, the calculation of payback period can be done in two ways. That is, when there is a cash flow is even, and during that time the formula will be the original investment divided by the annual cash inflow directly when there is a even cash flow. But when there is a cash flow is uneven, then we have to use the cumulative method. So, let us do let us solve a problem on it. Let us identify it, what is the payback period and how to compute the payback period. So here in which first problem is a project will cost rupees 10 lakhs and will have a life of 5 years and no salvage value. Assume 50% is the tax rate and depreciation under dimension or reducing balance method at 20%. The estimated cash inflow before depreciation and tax from proposed investment are follows. So this is a cash flow for every year. So for next 5 years, you are going to earn a income from this project. The project cost is 10 lakhs. The original investment is 10 lakhs. So now, basically in the payback, what we are going to see is on which year we are going to get our return or whatever the investment amount we have invested. Okay, so here there are 5 years the cash flow is given. So let us identify that. So now here the cash flow is uneven. How do you say it is uneven? Because every year the profit is changing. Okay, the cash flow is getting changing. So let us solve this problem. So this is the uneven cash flow. So here what they have given a cash flow before depreciation and tax. So what, but for us, for our calculation, we need a cash flow uh, before depreciation after tax. So that is the information what we needed. So we have to do the calculation. Let us move towards a calculation. Let me share the page. Yeah, I hope you can see the Excel sheet on it. So now here we could see the cash flow of first for 5 years, that is 32 lakhs, 3 lakh 32 lakhs and 3 lakh 20,000, 3 lakh 50,000, 3 lakh 90, 5 lakhs and 5 lakh 40,000. So this is a cash flow before depreciation and tax, but we need a cash flow after after depreciation, sorry, cash flow before depreciation and after tax. So this is the information we need. So how do we find out this? So first we need to find out what is a depreciation. So related to depreciation, what is the information they are saying? That is, for a depreciation there is no salvage value, which means that there is no scrap value for that, and the life of the asset is that information also they have given. And next is they are saying the depreciation will be calculated on written down value method. How do we do the written down value calculation? It's nothing but first year the original cost is 10 lakhs, so on the 20%, so depreciation will be 2 lakhs. So after minusing this 2 lakh, whatever the amount we are getting, right? So that will be the written down value as on written down value of the closing date. So closing date. So this closing date will be the opening date for the next year, opening value for the next year. So on this value, we are going to find out the depreciation. So how do we, next value is how much? 8 lakhs. So on 8 lakh, 20%, it is 1 lakh 60,000. Same way, third year. So this is how. So based on this calculation, we got the depreciation. So what is the depreciation for first year? It is 2 lakhs. Second year 1 lakh 60. Third year 1 lakh 28, and the fourth year 1 lakh 2,400, and fifth year 4 lakh 96,000. Okay. So this is a depreciation. Okay. Now next is cash flow after depreciation before tax. So cash flow before after depreciation and before tax. This is a cash flow after depreciation. This is the amount what we got. So let us see that. That is cash flow minus, just we have to minus, this is on 3 lakh 20,000. If you minus 2 lakhs, it is 1 lakh 20,000, 1 lakh 90, on which 50% tax. That is what they given in the question. So assume tax is 50%. So on which 50%, how do we do? It's nothing but on this value directly apply 50%. So if you do it, you will be getting this value. Next, what we have to do in this step, we have to minus the tax. Okay, whatever the tax we got, right? After minusing a tax, whatever we have got, that is a value here. So CFF minus tax. So that is what this amount. Okay, and next is next step is we have to add back the depreciation. Why we are adding back? Because we need information about cash flow before depreciation but after tax. Normally the tax can be calculated only after tax. So that is the reason initially first we calculated depreciation and we minus, later on tax we calculated. Now again we need to add back the tax amount. So that is what we did it. So this is a cash flow before tax, before depreciation and after tax. So once after this, Next, we have to adopt cumulative method. How do we do a cumulative cash flow? It's nothing but first year 2,60,000, second year 2,55,000, third year we got it. So now what we do is we have to cumulate. How do we do it? First year it is 2,60,000. Next year what it is there, which will be added with first year. So 2,60,000 plus 2,55,000 is 5,55,000. Same way 5,15,000 plus 2,19,000, it is 7,74,000. So now what is the information we need? We need a how much the original investment? It is 10 lakhs. Okay, so in the fourth year, how much we are getting? It is 10,75,200, which is going beyond our original investment. So we have to find out which year we are going to get it. So 3 years we got it. So this 3 years. So year before recovery is 3 year. In the fourth year only we are going to recover. That is what we are saying. Year before recovery is 3 years and plus amount to be recovered. So how much amount we need? 10 lakhs. Correct. 10 lakhs minus 74,000, which because only that amount is needed out of, see, already we got 7,74,000. So remaining out of 10 lakh, what is the amount? That amount we need to minus divided by, okay. So divided by that year cash flow. So that year cash flow is 3,01,200. So that if you do it 7.5 years, 7.5 years. So which means we have to add 3 plus 7.5 years. You will be getting this value. So this is how we can calculate the payback period. Okay. Thank you so much. So we'll see in the